Normative reasoning decision approach. It is one of the most important and at the same time most popular approaches for reasonable decision making. It is based on the idea of necessary information for making a decision, and at the same time based on the idea of calculating the best alternative to go through. Decision-making methods as a whole are a wide range of variety, but there are two main families: the judgmental methods based on subjective judgment, and computational methods based on computing something. And the normative reasoning decision approach is basically in the second one. And out of the judgmental, there are corrective and subjective. Collective judgmental methods typically are expert methods for decision making, such as, for example, the Delphi approach. And sometimes there are other which are called heuristics. On the computational side, there are the probabilities, decision-making methods, the historical extrapolation, and the computer simulation. The decision-making, the normative reasoning decision approach is within the probability type of computational decision-making methods. When we are speaking about any decision-making, there are decision-making steps that or stages that we should go through, and there are as follows. First is the goal and outcome formulation. This will enable decision makers to see exactly what they're trying to accomplish and keep them on a specific path. Problem recognition is the second stage. Understand when there is a significant difference between goal and actual outcomes. Third stage is gathering data. This will help decision makers have actual evidence to help them come up with a solution. Next is criteria formulation, a standard or test by which the outcomes may be compared and judged. Develop alternatives is the next stage. Coming up with more than one solution enables you to see which one can actually work. Evaluate each alternative. You can eliminate the solutions that have more cons than pros, making your decision easier. Next is the actual decision making. Once you analyze each solution, you should pick the one that has the most pros according to the criteria you have chosen. Next, after you have made the decision, take the action. Once the decision is picked, you should implement it right away. Finally, you should go to feedback, learn from, and reflect on the decision making. This step allows you to see what you did right and wrong when coming up and putting the decision in use. When we're speaking about normative reasoning decision approach, there are some initial definitions, which I would like to state pretty easy. First is problem. What is a problem? Problem is a situation, condition, or issue which presents a significant difference between future actual outcome and desired outcome. I would like to elaborate here a bit more. Every one of us has some desires, and if there is significant difference between what we desire and what we expect to happen, we are in a so-called problematic situation or a problem. And this is the easiest way to define a problem, the difference between actual outcome and desired outcome. Okay, next definition is a decision maker. This is an entity, it could be a group or an individual, who is responsible for solving a problem. Next, alternative. one out of several feasible, non-combinable solution to a problem. So I would like to explain here a bit more. First of all, there must be more than one alternative. So we have already spoken about the variability of risky situation. If there is only one alternative, there is probably nothing to decide. Everything is already decided for. Second important keyword here is the non-combinable. If we have combinable solutions, so I may do this and that at the same time, we are not speaking about the normative reasoning decision approach. We are most probably speaking about portfolio reasoning decision approach. Third and probably most important is that each of these alternatives should be feasible, so should be realistic and should be able to be executed on. Next key term is decision. What actually decision means? Decision basically is choosing the best one of two or more alternatives, considering the expected outcomes from each one of them. So basically, another explanation here, there are at least two alternatives. We have to choose at least one, so we are facing some sort of uncertainty. This uncertainty actually is arising from the fact that there are at least two possibilities, maybe more, and we have to choose one, less than the. So one important issue here is that there are no possible alternatives which the decision maker doesn't consider. So there is no prejudice. Everything that is possible is considered as a viable alternative. The next thing is that the outcome of a decision depends on two categories of phenomena. First, the so-called strategies or alternatives. These are the phenomena controlled by the decision makers. And the externalities or factors of the environment or factors of nature are state of nature. These are non-controlled by the decision maker. So basically, if we want to have problem situation solved, we need to constitute it. And there are 5 requirements for in the normative reasoning decision approach. And I'm going to sum basically everything up to now in these 5 requirements. First of all, there must be 2 or more alternatives or strategies that the decision maker should choose from. Second, there should be various states of nature. These are phenomena that are outside of the control of the decision maker. Third, there should be estimates for each combination of alternative and a state of nature. So let's say I have 3 alternatives and I have 2 state of natures. Altogether, I should have 6 combinations, and for each of them I should have estimation, which basically means a number of the outcome. It could be a favorable outcome for me, or it could be non-favorable for me. But anyway, we need to have, third requirement is we need to have estimates for the outcomes of each combination. Fourth requirement is that we should know the information level of the decision maker. And we're going to explain on this a bit more further down. And fifth, we need to have a decision rule or criterion which may depend also on the subjective judgment of the decision maker. It may arise from the professional, the profession of the decision maker, the position which he is in, or personal philosophy. To go on, I will need to explain what decision matrix is. Decision matrix is basically a table where all these requirements that I have explained just now are put together in one place. First of all, we have the alternatives. So each row represents a given alternative that the decision maker should choose from. Each column represents states of nature. So these are the things that are outside of the control of the decision maker. And each cell represents a number or estimation of the outcome of what would happen if, let's say, I choose alternative number 2 and state of nature number, okay, let's make it number 3 occurs. So there is a number that would be the payoff or the outcome for the decision maker. Additionally, there might be additional values here. These are the probabilities for each of the state of nature occurring. There might exist or there might not exist. We might have knowledge about this or might not have knowledge about this. And in any case, they are part of the decision matrix. So basically, once more, we have n numbers of alternatives, n numbers, or maybe more or less numbers of states of nature. We have probabilities. And there is one important feature here. It is what sort of numbers we have here. If these estimations depict a number where, or a situation where bigger number is more favorable for the decision maker, we will denote this as a normal decision matrix. Bigger is better. And this is, for example, if we put here profit. The higher the number of denoting profit, the better for the decision maker. There might be cases when we have actually inverted decision matrix, where the smaller the number, the better outcome. Imagine that we have put here something like costs. So the decision maker have to decide among alternatives how to build a house, for example. And depending on what sort of factors there are, for example, location of the house or the season when we are building, or the market for commodities or whatever, we might have higher or lower costs. So if we have costs here, the lower the number, the better for the decision maker. And in this case, we would have an inverted matrix. And every time we make a decision using the normative reasoning decision approach, we should always first check whether this is a normal decision matrix or an inverted decision matrix. Otherwise, we might make a big mistake. In order to explain the normative reasoning decision approach from now on, we're going to use a very popular problem, which is called the newspaper boy problem. Imagine that you are a newspaper boy. You're actually selling not newspapers, but expensive magazines. Since they are expensive, you cannot buy a lot of them. You can only buy up to 5. Another reason why you're not going to buy more is that in the neighborhood where you're selling these magazines, there are only 5 potential customers. So if you buy 6 magazines to sell to the customers, you basically end up with, for sure, losing the money for the cost for the 6th, because there will be a maximum of 5 customers. So we have a states of nature 0 to 5. We might have in this month we might have only non-customers come to buy a magazine from us. We might have 1 or 2 or 3 or 4 or 5, but no more than 5. And these are the states of nature, 1 to 5. From our point of view, there is no point of buying 6 magazines We might buy less, but no more than this. So basically, we correspondingly have alternative strategies from 0 to 5. So we might order 0 this month and basically say that we do not want to make business this month. Or we might buy 1, expecting to sell it to at least 1 customer, or 2 or 3 or 4 or 5. To have this, we now have our alternatives, we have our states of nature. To have an estimation of the outcomes for each combination of alternatives and strategies, we need to have some additional numbers. And this would be that the selling price of the magazine costs 15 euros and the ordering price costs 5 euros. I would like to remind you that in this case, the decision matrix is 6 by 6 squared, but it is not at all necessary, nor it is very common to be a square matrix. And furthermore, in this case, since we're dealing with the profit, we're aiming at maximum profit, we're going to have a normal decision matrix. So how does this look here? Well, it looks something like this. This is the newspaper problem put into a decision matrix. Let's see here. These are the states of nature. These are the alternatives. Let's say if I have ordered 2 magazines this week and there is only 1 customer, I'm going to earn $5. Why $5? Because I'm going to earn a profit of $10 for the first, 10 euros for the first customer. It doesn't really matter, the currency. So I'm going to earn 10 euros from the first customer. And since there is no one else to sell my second magazine, I'm going to have to take the profit of -5. And altogether, they become a profit of 5. So let's say I order 1 magazine and I have nobody come to me, I end up with a profit of -5. In this case, we can see, and it's not at all necessary to have this in every normative reasoning decision approach problem, but in this case, all the minimum negative profits are grouped in the first column, and all the best profits are grouped in the last column. Anyway, you get the idea how this decision matrix is full. Now, let's try to solve it one by one. If you remember, we needed to have 5 requirements. The first 3 are already met. We have the states of nature, we have the alternatives, we have the estimation of the outcomes. Now we need to know the level of information of the decision maker, and finally we need to use a criterion for the decision rule. Let's move to point number 4. There are basically, according to the theory, there are basically 4 different cases of decision-making information, and they are under certainty, under risk and uncertainty, and under complete uncertainty. I'm not going to explain the case under complete uncertainty because it is a topic for another class, but I'm going to explain the other 3 examples right now. So first of all, under certainty. Well, under certainty, the decision maker knows for sure exactly which state of nature will occur, which state of nature will be realized. And in this case, let's assume that we know for sure that there is 1 customer that will come for the next month. Maybe everybody is on a summer holiday and there is only 1 here, and he has stated that he would come to buy from me. So I know for sure, and I believe him, I know for sure that there is 1 customer that will come to buy this month from me. So out of these alternatives, I would like to remind you there are 6 alternatives: buying 0, buying 1, buying 2, 3, 4, 5 magazines. Which should be our decision, the one that maximizes our profit? Well, basically, it is the decision. Well, first of all, the maximum profit we have is 10, which corresponds to the alternative of ordering 1 magazine. And of course, this is obvious. If I know that for sure there is only 1 customer to come, I'm only going to order just 1 magazine to sell to him. So what is important here? Under certainty, only 1 state of nature is considered. Second important thing here is what is the decision methods here used. Typically is optimization methods aiming at profit maximization. Basically this is a subcase of the decision under risk. Okay, next case, this decision under risk. The decision maker doesn't know for sure which state of nature would be realized, but there is a probability estimation for the realization of each state of nature. Which basically means that in our decision matrix, we not only have the states of nature and the alternatives, but we also have estimation for probability of occurring of each of the state of nature. I would like to remind you that the sum of these should be equal to 1 or to 100%. What do we do in this case? Well, we do something that we have already covered in the previous lectures. It is the mathematical expectation, or the so-called expected value. What do we do? I would like to remind you, we take the probability. Okay, let's consider this row first. We take the probability of occurring multiplied by the given outcome. Then we take the probability and multiply it by the given outcome, and so on and so forth. And then we sum all these results. And what we will have at the end here is the expected value for each alternative. And when we have all the expected values for all the alternatives, we can figure out which is the best alternative to choose. So how does this look like? Well, it looks like something like this. We have, for each alternative, we have I'm going to use the alternative of using 1 magazine. We have the outcome multiplied the probability for this outcome, plus the outcome multiplied by the probability for this outcome, and so on and so forth, and all of this summed. And since we have, and when we sum all this for each alternative, we derive expected values for each alternative. And what happens next is that we basically have results. Since this is a normal decision matrix, we are looking to maximize our profits. We are going to look for the maximum possible results. In this case, it's 13.5 expected value. And in this case, this means that we should order 3 magazines for the coming month. Of course, given these probabilities. You can go on and try to calculate this same example for yourself. I have done this for you, but it is a good exercise to try to do it yourself as well. Next is decisions under risk and uncertainty. It is an important and probably the most often typical case. It is when the decision maker knows the possible states of the nature, but does not know which one will be realized, nor does he know probability estimation for realization of each state of nature. So basically, we do not know any probabilities. So what do we do now? Well, there are the so-called decision rules or decision criteria that could be used for especially this situation under risk and uncertainty. These are, actually there are 6. I'm going to skip the 6th one. It is an interesting decision rule which renders the individual preference towards risk, which is in connection with what we have spoken in the previous lectures. But since it's not that popular, I'm only going to stick to the most popular ones, which are these 5 decision rules, which are the VALT decision rules of conservative expectations, the total optimistic decision rule, sometimes jokingly mentioned or known as the fool's rule, the Hurwicz decision rule, rendering optimism preference, and the Laplace decision rule, which is the rule of equal probabilities. And there is one more, which is a bit more complex, a bit more sophisticated, which is called the Savage decision rule, which is based on the so-called matrix of appropriateness or matrix of regret. Okay, now let me explain, before I start explaining the decision rules, that each of these decision rules is typical to a given philosophy. So every decision maker should or probably already have one of these rules already implemented in his actions, in his decision making. So let me start with the VALT decision rule of conservative expectations. This decision rule is based on the idea that whatever we decide to do, always the worst possible outcome would occur. So it is to some extent very pessimistic. This is why it's called conservative expectations. Basically, whatever I decide, I am expecting that the worst possible outcomes will happen. So what we do is try to pick the alternative that has the least worst possible outcomes. So in other words, we are looking for the least evil. When we're speaking about a normal matrix, this would mean the so-called max mean. And when we're speaking about inverted matrix, this would be min max. Let me show you how this is done. First of all, we look throughout the whole row of estimated values of outcomes, and we take the smallest possible number. So we decide that whichever alternative I use, there is always going to be the worst possible outcome to be realized. And then out of those picked numbers, I'm going to go to the maximum possible. So this is why it is called maximin. Maximum out of the minimum. So how does it look here? Okay, the maximum, okay, the worst possible outcome for alternative 0 is 0. The worst possible outcome for alternative 1 is -5. For alternative 2 is -10, and so on and so forth. They are all here. And which is the least evil out of these possible outcomes? Basically, it is this. It is 0. And it says that we should pick the alternative which says order 0 magazines. So we have used or made a decision without even having probabilities, only looking at the decision matrix. And in this case, the decision says that we should not order any magazines. And this is somewhat expected because the VALT decision rule, I would like to remind you, is actually a very pessimistic one. We expect that nobody would come, and since nobody would come, the best strategy is to just order 0. Well, this is about this decision rule, but let me ask you, is this a good business decision? I'm trying to make some money, but because I'm too afraid to take some risks and I'm pessimistic about the future, I am basically skipping my business. I'm basically running away from my business, ordering zero. Well, obviously, it's not a good business decision. So how come this is a viable decision criterion? Well, this is a viable decision criterion when we're speaking about, let's say, pilots. Pilots in the aviation are taught to decide on the VALT criterion all the time. Whatever they do, they look for the worst possible outcome that might happen, and they take this action which gives them the least evil. Now, if we're speaking about a bit more optimistic decision rule, the next one is the total optimistic decision rule. It underlies the idea that whatever we do, always the best possible outcome would happen. And basically, this means that we are going to choose the best of the best, or the so-called max, maximum out of the maxima. This is, of course, because we're dealing with a normal decision matrix. If we were dealing with inverted decision matrix, it would have been minimum out of the minimum. And let's see how it looks like here. The best possible outcome if I order 0 magazines is 0. The best possible outcomes if I order 1 is 10. If I order 2 is 20. If I order 3 is 30, 40, 50. Basically, here are the best possible outcomes, and the best out of the best is 50. And according to the totally optimistic decision criteria, we should order 5 magazines. Okay, now we have covered the VALT decision rule, which is fairly pessimistic. The somewhat opposite to it is the totally optimistic decision rule, which is fairly unrealistic, too optimistic, you may say, and too opportunistic. So now that we have the two most extreme cases, could we have some decision rule that is somewhere in the middle, not taking too much risk, but at the same time having some optimistic approach to future. Such decision rule is the Hurwitz decision rule, which has one important feature. It implements the so-called coefficient of optimism. The coefficient of optimism, alpha, is a number between 0 and 1, where 0 means a total pessimist and 1 means a total optimist. And what we do is we weight with, or multiply basically, with alpha the best possible outcome for each alternative, and with 1 minus alpha, so with the residual after alpha, we multiply the worst possible outcome and sum the result of each alternative. So basically what we do is take the best features of the two previous decision rules, from the VALT decision rule and the totally optimistic decision rule. So let's assume alpha is 0.6. So fairly moderately optimistic decision maker. So what we're going to do is multiply the biggest number of each row by alpha, which is 0.6, and the smallest number of each row by 1 minus alpha, which is 0.4. And sum both results for each row, and choose the biggest sum, because we are a normal matrix. If it was an inverse matrix, we would have chosen the otherwise. How it looks here. Okay, for 0, we have the best possible outcomes is 0. The worst possible outcome is 0. 0.6 multiplied by 0, 0.4 multiplied by 0, it is 0. And then for the alternative number one, for alternative where we order one magazine, we have 10 multiplied by 0.6, this is the best possible outcome, and minus 5, the worst possible, multiplied by 0.4, and so on and so forth. And what we end up is a result on this decision rule for each alternative, and then we seek the best possible outcome. So since we are maximizing profit, this is the best possible outcome here when we order 5 magazines. I would like to remind you that if we had not alpha equal to 6, to 0.6, but some other number, let's say 0.3, then most probably we would have ended up with a different alternative somewhere here. And for the sake of exercise, you might pause the video here and use another value for the alpha and try to compute the values and see what would be the alternative chosen by this decision criteria. So far, all the decision criteria under risk and uncertainty were starting to analyze row by row, which means alternative by alternative. The next two are actually starting to analyze column by column, starting with the so-called Laplace decision rule. I don't think I have enough time to explain about all these people that are behind this criteria, but I will explain something about Laplace. Marquis de Laplace has been an adventurer, a gambler, and a mathematician, consequently. He has a very pragmatical way of thinking about the world. And he said, since we don't know any of the probabilities, since we are under risk and uncertainty, we don't have probabilities for the states of nature, then there is no base to assume that one state of nature is more probable than the others. So we don't know them, which means that we cannot assume that one is more probable than the others. And basically, we can assume that all the states of nature are equally possible. So this is actually a very easy calculation from now on. We are going to have a 1/6, in our case, 1/6 probability for occurring for each state of nature. And it is really a subcase of decisions under risk. We are going to calculate the expected value for each alternative and see which is the maximum. And since it is equal probabilities, what we're basically really going to do is compute an arithmetic mean. And here is how it looks. We're assuming all the possible outcomes for this alternative, and we divide it by 6. And we do this for all the other alternatives, and what we end up with is result for Laplace decision rule for each row. And since we are trying to maximize our profit, we are looking for the maximum possible outcome. In this case, there is something additional interesting. It is that there are 2 equal alternatives. This might have occurred in the previous decision rules as well. We have not encountered it, but nonetheless, it is an interesting thing. First of all, we should choose between, let's finish with the Laplace decision rule. We should choose between 3 and 4 magazines. They each maximize the same profit of 15, expected value of 15. And some might say, I would like to go for the 3 magazines, which means take the less risky decisions. Some might say, I would like to go to the 4 magazines, have a bit more possibilities for earnings. It doesn't really matter, but the principle of solving a case when we have a tie break is the so-called principle of necessary addition. It is something we have to add some new rule, some new criterion that we have not used so far in solving this problem. For example, I'm inputting a new rule that if we have a tie break, I would go for the less risky, and this means I would go to the, for example, the 3 alternatives. Nonetheless, we are not trying to solve really the problem. We are only trying to give it as an example. So I would like to remind you, under the Laplace decision rule, we have the assumption that all the probabilities for each state of nature are equal, and this means that we can solve it through equal probabilities expected value. And when we have this, we then decide which is the profit maximization alternative. In this case, it happened to be a strange case of having a tie break. Now, we move on to the fifth and final decision rule under risk and uncertainty. It is the so-called savage decision rule. The savage decision rule is actually a bit more complex, a bit more sophisticated, because it actually has two stages. One stage is that we actually reconstruct the decision matrix, and second stage is in the newly constructed decision matrix we make our decision. So starting from analysis in columns, as I already stated, we can see that for each column, so for each state of nature, there is at least one single best solution. There might be more than one, but at least one single best outcome. So for example, here, the single best outcome is here in this cell, the single best here is here, the single best is here, and so on. For our case, it is always on the main diagonal, the main weak diagonal. But first of all, now we have the notion which is the best possible outcome for a given state of nature. So whenever a state of nature occurs, I know if I presume that a state of nature occurs, I know which would be the best possible outcome for this state of nature. And what I'm going to do is compare all the other values in the same column, so for the same state of nature, with the best one. What does compare mean? It basically means to subtract. So what I'm going to do is to see how different is 0 to -5. So how my result differs from the best possible. And one important thing here is that while subtracting, I'm only interested in the absolute value of the difference. So I'm always going to put the positive values here. So for example, -5 minus 0 is 5, -10 minus 0 is 10, and so on and so forth. So the higher the number here in the new matrix is actually the worse off for the decision maker. So what we have, the new decision maker, the new decision matrix actually has interesting features. First of all, the higher the number there, the biggest the regret or the biggest the missed opportunities for the decision maker. So first of all, we have the so-called matrix of regrets. Second of all, we have an inverted matrix. Since the higher the number, the worse off for the decision maker, there is always going to be an inverted matrix. So one important thing, no matter what was the original decision matrix, after we make the matrix of regret, we're always going to end up with an inverted matrix. The matrix of regret is always an inverted matrix. So this is the first stage. Make the transition from one decision matrix to a matrix of regret. And second stage is using most of all, applying the VALT decision criterion on the newly constructed matrix of regret. And how do we do this? Basically, look row by row, see which is the worst possible outcome, and then pick the worst, the best out of the worst. And I remind you that this is an inverted matrix, so it will be the so-called min-max, minimum out of the maxima of VALT. I have put this here. Find the biggest number in each column, which is the worst possible outcome. Construct the matrix of regret, and then use the min-max of VALT as a decision rule. So what happens here? I have shown you how to construct the matrix of regret. Now, looking here, the first row, the worst possible alternative is 50. The second row, the worst possible alternative is 40. Here is the worst possible is 30. Here is 20. Here is 20, and here is 25. And the least worst out of these 6 numbers is 20. These are they are the closest to the perfect. And we are ending up again with a tie between ordering 3 and ordering 4 magazines. Right. So now I'm going to give you an example. You should try to solve this problem yourself. Imagine that there is a manager of underwear factory. He has to decide what to produce next year. It is expected that it would be a year of higher inflation or a year of low inflation. Well, this right here tells us that there are 2 possible states of nature, higher inflation and lower inflation. We presume that we cannot control the inflation. The manager is a moderate pessimist with an optimism parameter of alpha equal to 0.3, so basically moderate pessimist. We will need this number for the Hurwicz decision rule. Most likely, the F1 state of nature would be realized, which means that under certainty, we're going to use this column denoted in F1. And under risk and the probabilities are F1 are equal to 0.4, under F2 equal to 0.6. Where F1 is the high inflation state of nature, F2 is the low inflation. And we have 3 alternatives: polyester underwear, silk underwear, and cotton underwear. And we have, obviously, of course, the outcomes estimated in numbers, and this is profit. This means that the matrix is a normal decision matrix. And now I would like you to pause the video and take some time, as much as you need, to try to solve this problem, expected profit. And under risk and uncertainty, first of all, the VALT decision rule, it brings us, we take the worst possible case every time. So whatever I decide the worst would happen. The worst here is minus 20, minus 10, and 20, and the best out of this worst is 20. So cotton underwear would be the best alternative in this case. Then the totally optimistic rule, I take the best out of the best, and the best out of the best is 60. So in this case, silk underwear would be the most suitable. When we calculate the Hurwicz criteria for with the coefficient of optimism, we multiply 0.3 with the best possible outcome. So the best would be here for this alternative would be 40,000 by 0.3 is 12, minus 20 multiplied by 0.7, which is the residual from 0.3 to 1. And this is minus 40, so this is 14, so this is minus 2. This is 18 minus 7 is 11, and 40, so it is 12 plus 1426. So cotton underwear would be the best possible alternative for if we use the Hurwitz decision rule. Laplace, I remind you, computes that it's, well, since we don't have enough information about the probabilities, we cannot assume that one probability is higher than the other for each state of nature. And this means that we basically make expected value with equal probabilities, and this basically means arithmetic mean or arithmetic average, which is 10 here for this. This is 25, and here is 30. 40 plus 20 divided by 2. And the best possible alternative in this case is the cotton underwear. And finally, the Savage decision rule. We go column by column, see where is the best possible outcome, and compare all the others we did. So it will be the new decision matrix will have 80s, 80 here, 0 here, and 20 here. It would have 0 here, 50 here, and 20 here. And then we have in the new matrix we apply the Wout decision rule, the min-max of Wout, and we end up with having the best possible alternative is cotton underwear. Okay, the next example I'm going to give you, just to have an exercise, is somewhat different. He's a manager of an automobile factory who has to make a decision whether to invest in new technology. The expected costs in millions are estimated in relation with the expected economic growth. Optimism parameter is 0.4. Most likely F2 will be realized, and the risk probabilities are 0.2, 0.5, and 0.3. Take some time and try to solve this problem. Pause the video right now. Okay, now that you have tried to solve it, I'm not going to solve it for yourself. You have this time to exercise it yourself, but I'm going to put two things that are important here. First of all, it is that this matrix is inverse matrix, since the higher the number it is costs, the higher the number, the worse off for the decision maker. And the second thing is that basically in this case we have one specific situation where we have one alternative better than the others on every state of nature. So alternative 1 is better than alternative 2 here. We have less cost here, better here, and better here, and it has better than is better than alternative 3 here, here, and here. So in this case, we are speaking about the so-called dominant alternative, and every time we have a dominant alternative, we should not compute anything, because we know that this is the only reasonable alternative to go to. Dominance means that it is being better in any case, or at least tied with the others. So it is on every state of nature, so it is the obvious choice.